Hey everyone, Dalton Grados with Grados Capital here. Wanted to make a quick video on a really cool options trade that I placed this week. But before I do, make sure you go ahead and like this video, subscribe to the channel, and also follow me on Instagram at Grados Capital. Now, let's get into this trade. So if you follow this channel, you know that I am an options trader. And as one of my trading mentors, Peter Rezenchek, says, they don't call them options for nothing. You have many options when it comes to options trading. And so this is an example of a risk-free trade that I structured. And if you follow me on Instagram, you would have seen that I posted a sort of a summary of it. I'm just going to go over it in this video in a little more in depth. So here's some real hedge fund stuff that I did today. Because this is a really cool strategy and can definitely work in the right scenario. So I was trading SPX and SPY, the S&P. And so once we made a breakout to the upside, I sold a 0 DTE put credit spread, which many of you guys know I like to trade 0 DTE credit spreads. Now, when you sell a credit spread, of course, you receive credit to your account. And when those options expire worthless, you keep all of the credit. This was a credit spread expiring that day. And so I received the credit and it expired worthless. But the credit was in my account as soon as I placed the trade on. So then I used that credit from the credit spread to buy a 450 SPY call for next week. So that's just your basic long call. I just bought a call, but I bought it with the money that I got from the credit spread, okay? And now the call increased in value in the same day, right? So I was up money. And then I was able to sell the 451 call strike for more than I bought the 450 call for, creating a debit spread. Now, normally when you create a debit spread, you buy a call and then you sell a call at a further strike price, and the call you sell is less value than the call that you bought. However, I bought the call, the value went up, and then I was able to sell the call, which would normally be lesser value. I sold it for more than what I initially bought the 450 call for. This creates what is referred to around the internet as the Ghetto Spread, because I bought the 450 call for 78 cents, sold the 451 call for 83 cents, locking in $5 of profit while still remaining in the trade. So if the market continues to go up, I will make money. However, if the market rejects this certain level, it was last week, if we were approaching the 21 DMA, if we reject it and the market falls, which we actually did, I walk away from that trade with $5 profit. So it's a risk-free trade. The worst thing that can happen is I make $5. And then I also pocket the full amount from the credit spread, which funded the whole trade to begin with. So hopefully this is a cool trick to add to your options trading, using a credit spread to fund a long call, and then once that long call increases in value, locking in profits by turning it into a debit spread, or referred to as a ghetto spread, to lock in the profits and remain in the trade so you can still continue to have upside but no risk on the downside. Again, this is Dalton Grados with Grados Capital. Again, like this video, comment, subscribe, and follow me on Instagram as well. I'll see you guys next time.